Melbourne's property market is collapsing. Not softening, not correcting, not taking a healthy breather. Collapsing. And the ugly truth that nobody in the real estate industry wants you to hear is that this is only the beginning. While agents keep telling you it's a great time to buy, while media outlets cherry-pick one good auction result to write a feel-good headline, the actual data is painting a picture so brutal that it should keep every Melbourne property owner awake at night. I'm not here to sugarcoat this. I'm not here to protect anyone's feelings or anyone's commission. I'm here to show you exactly what is happening on the ground in Australia's second largest city, why it's happening, and what it means for your money, your mortgage, and your future. If you own property in Melbourne or you're thinking about buying, the next few minutes could be the most important financial reality check you get this year. Let's start with the numbers, because the numbers don't lie, even when the industry does. Melbourne's median house price has been falling consistently since its peak in early 2022. According to CoreLogic, values across Greater Melbourne have dropped over 7% from that peak, and in some suburbs, the decline is significantly worse. We're talking double-digit percentage drops in areas that were once considered blue chip. Suburbs in the outer west, the outer north, and parts of the southeast have seen falls of 15 to 20%. That's not a correction, that's a crash by any reasonable definition. On a property worth $1 million at the peak, a 15% drop means $150,000 of wealth has simply evaporated. Gone. Not temporarily displaced. Gone. And for many homeowners who bought at or near the peak with a 5% deposit, that means they are now in negative equity. They owe more on their mortgage than their home is worth. That is the definition of being financially underwater. And thousands of Melbourne homeowners are drowning right now without even realizing it. But the price drops are only one layer of this disaster. The second layer is volume. Melbourne's total property listings have surged to levels not seen in over a decade. According to SQM Research, there are now over 35,000 properties listed for sale across Greater Melbourne at any given time. That is an enormous wall of supply hitting a market where demand has virtually collapsed. Buyers have pulled back dramatically. First home buyers can't afford the repayments at current interest rates. Investors are fleeing the state entirely thanks to Victoria's punishing land tax changes and rental reforms, and overseas migration, which was supposed to be the demand engine that saved everything, has not translated into buying activity because most new arrivals are renters, not purchasers. So you have a massive oversupply of properties hitting the market with nobody to buy them. That is the textbook recipe for a price collapse, and Melbourne is following that recipe step by step. Now let's talk about the demand side in more detail, because this is where it gets truly ugly. The Reserve Bank of Australia's aggressive interest rate hiking cycle has fundamentally broken affordability in Melbourne. A household earning the median Melbourne income now needs to spend over 50% of their pre-tax earnings just to service a mortgage on a median-priced house. 50%. The historical benchmark for mortgage stress is 30%. Melbourne is nearly double that threshold. This means that even people who want to buy simply cannot. The borrowing capacity of the average Australian buyer has been slashed by roughly 30% since the rate hikes began. Someone who could borrow $800,000 in 2021 can now borrow around $560,000. That is a catastrophic reduction in purchasing power, and it has gutted demand at almost every price point in the Melbourne market. And it gets worse when you look at investor activity specifically. Victoria has become the most hostile state in Australia for property investors. The land tax changes introduced in 2023 lowered the threshold so aggressively that investors who held properties worth as little as $300,000 were suddenly hit with land tax bills they never budgeted for. Some investors saw their annual land tax obligation increase by 500% overnight. Combine that with rental reforms that heavily favor tenants, insurance premiums that have doubled in 3 years, council rates increasing above inflation every single year, and mortgage repayments that have jumped by 40 to 60% since 2022, and you have a situation where the vast majority of Melbourne investment properties are now cash flow negative by significant margins. We're talking losses of $500, $1,000, even $1,500 per month. Per month. That is not investing. That is bleeding. And the blood is flowing out of Victoria at an alarming rate. ATO data shows that Victoria has recorded the largest net loss of property investors of any state in Australia. They are selling up and redeploying their capital into Queensland, South Australia, and Western Australia, where the numbers actually work, and the government doesn't treat them like villains. The auction market tells the story in the most visceral way possible. Melbourne has always been an auction city. It's part of the culture. Saturday mornings, crowds on the footpath, competitive bidding, properties selling well above reserve. That image is dead. Current auction clearance rates in Melbourne are sitting in the low 50% range, and in some weeks they've dipped below 50%. That means roughly half of all properties taken to auction are failing to sell. And here's the detail the industry doesn't want you to know. Many agents are pulling properties from auction before the event even happens because they know there are no registered bidders. Those withdrawn auctions don't get counted in the clearance rate data. If you included them, the real clearance rate would be in the low 40s or even the high 30s. That is a catastrophic level of market failure. Properties that do sell at auction are frequently going below the reserve price because vendors are desperate and accept lowball offers just to get out. The power dynamic in Melbourne has completely shifted from sellers to buyers, and it hasn't been this extreme in over a decade. Let me address the elephant in the room. What about population growth? Melbourne is the fastest growing city in Australia. Isn't all that population growth supposed to drive demand and push prices up? In theory, yes. In reality, no. And here's why. The type of population growth Melbourne is experiencing is almost entirely rental demand, not purchase demand. The overwhelming majority of new arrivals, whether from interstate or overseas, do not have the savings or the income to buy property at Melbourne prices, especially at current interest rates. They need rentals, and while that has pushed rents up significantly, it has done almost nothing to support property purchase prices. In fact, it has created a bizarre paradox where rents are rising while property values are falling. That might sound like it benefits investors, but it doesn't because the rent increases have not been large enough to offset the combined impact of higher interest rates, higher land tax, higher insurance, and higher compliance costs. Investors are still going backwards even with higher rents. The math simply does not work. So where does this end? When does Melbourne hit the bottom? The honest answer is that nobody knows. But I can tell you what the leading indicators suggest, and they are not encouraging. Listings are still rising. Distressed sales are increasing quarter over quarter. Mortgage arrears in Victoria are climbing toward levels not seen since the global financial crisis. The RBA has signaled it is in no rush to cut rates aggressively, which means the affordability crisis will persist well into 2026, and the Victorian government shows absolutely no signs of reversing its anti-investor policies, which means the capital exodus will continue. When you add all of that together, the most likely scenario is that Melbourne property prices have further to fall. How much further is debatable, but credible analysts are suggesting another 5 to 10% decline from current levels is realistic before any stabilization occurs. On top of the drops that have already happened, that would take some suburbs to 30% below their 2022 peaks. 30%. Let that number sink in. Now here is the critical question for you. If you currently own property in Melbourne, what should you do? First, do not panic sell based on a YouTube video, but do get informed. Run your numbers today, not the numbers from when you bought, the numbers from right now. Calculate your actual holding costs, including mortgage repayments at current rates, land tax, insurance, strata if applicable, maintenance and management fees. Compare that to your rental income or your imputed rental value if you're an owner-occupier. Understand your true financial position. If you are deeply cash flow negative with no capacity to sustain the losses, holding and hoping is not a strategy. It is a gamble, and the odds are not in your favor. If you're thinking about buying in Melbourne right now, understand that you may be catching a falling knife. Yes, prices are lower than they were, but lower doesn't mean cheap, and lower doesn't mean they can't go lower still. The smartest buyers in this market are the ones who wait, watch, and strike only when the fundamentals genuinely turn. That means waiting for clear signs of listings declining, clearance rates recovering above 65% consistently, and genuine affordability improvements, either through rate cuts or meaningful price reductions. Until those signals appear, patience is your greatest asset. This is the ugly truth about Melbourne's property market. It's not what the agents want you to hear. It's not what the government wants to admit, but it is the reality, backed by data, confirmed by trends, and proven by thousands of investors and homeowners who are living this nightmare right now. The question is whether you'll act on this information or ignore it and hope for the best. Hope is not a financial strategy. Knowledge is. If this video opened your eyes, hit that subscribe button right now and turn on notifications, because the Australian property market is moving fast and you cannot afford to be the last one to know